Hey everyone, Robert here, and I need you to stop what you're doing right now because what unfolded in the silver market over the last 48 hours isn't just another routine correction. This is the kind of price behavior that separates people who understand market mechanics from people who are about to learn an expensive lesson. We just witnessed silver climb aggressively toward that critical threshold, the number that makes institutional desks nervous, the number that turns whispers into phone calls, and right when momentum looked unstoppable, something happened that should make every single silver investor sit up and pay attention. If you're holding physical, if you're trading futures, or if you're just trying to make sense of why this market can look dead for months and then explode into chaos within days, you're in exactly the right place because I'm going to break down what yesterday's sudden reversal actually means, what the hidden stress indicators are telling us that most analysts are completely ignoring, why the psychological barrier everyone's obsessing over is only half the story, and what I'm monitoring right now that could either trigger a massive liquidation event or launch the next explosive leg higher. And toward the end, I'll reveal the single most common mistake that destroys retail silver investors during bull markets, even when their thesis is completely correct, and how sophisticated institutional players exploit that mistake systematically to accumulate metal while the crowd is panicking and selling at exactly the wrong time. Now, before we dive deep into the analysis, I need to ask you for something quick. My analytics dashboard is showing me something frustrating. The majority of people watching these breakdowns regularly still haven't hit the subscribe button. Look, I understand you can consume the content without subscribing, but if you're extracting any value whatsoever from these market insights, do me a solid and click that subscribe button right now. We're making a serious push to hit 75,000 subscribers within the next 45 days. And your single click actually carries more weight than you realize in terms of reach and impact. Also, for those who want to go deeper, we're now consistently publishing exclusive member-only content that you won't find anywhere else on the channel. This isn't repurposed material or recycled takes. We've built a dedicated research team working behind the scenes to produce in-depth analysis and market updates exclusively for our premium members in the core Robert community. If you want access to that level of insight, hit the join button immediately or follow the link down in the description below. All right, let's get straight into the meat of this. What happened yesterday wasn't just standard market volatility or normal profit-taking behavior. It was a signal. Silver pushed aggressively higher toward that psychological pressure point, and then suddenly, almost violently, a wave of selling pressure hit the market in a way that didn't match typical profit-taking patterns. It felt coordinated. It felt defensive. It felt like somebody desperately needed that price to retreat from a dangerous edge. And here's what the majority of market participants completely miss in moments like this. When silver gets hammered like that at a critical resistance level, you cannot simply look at the price decline in isolation. You have to examine what else was happening simultaneously across the entire market structure. Because while the spot price was getting crushed, something extremely unusual was occurring in the physical market. The cost to borrow actual metal, what we call the lease rate, suddenly spiked upward. That's a bizarre combination that should immediately raise red flags for anyone who understands market mechanics. Think about this logically. If the market was genuinely well supplied with metal, if sellers were relaxed and physical inventory was abundant, you would not typically see borrowing costs surge at the exact moment paper selling appears on the screen. In a normal, comfortable, well-supplied market, lease rates stay low, almost dormant, hovering at fractions of a percent, barely noticeable background noise. But when lease rates jump sharply, when they spike hard and fast, the market is essentially screaming that physical metal is becoming tight. So let's pause and absorb what this means. The paper market is saying sell, dump your positions. The trend is breaking. Meanwhile, the physical borrowing market is simultaneously saying pay up, metal is scarce, supply is constrained. Those are two completely contradictory realities colliding in real time. And that collision, that tension between paper and physical, that's where the actual story is hiding beneath the surface noise. Now, could silver still experience another pullback next week or the week after? Absolutely. In fact, I would be genuinely surprised if we don't see at least one more terrifying dip somewhere along this journey. Silver never moves in smooth, predictable increments. It doesn't climb a steady staircase. It moves like a staircase being constructed during an electrical storm, chaotic, violent, unpredictable. But the critical question isn't whether it can dip again. The critical question is, what type of dip are we looking at? Because there's a dip that clears out excess leverage and resets the market for the next leg higher, and then there's a dip that signals the underlying trend has completely died and reversed. And if you don't understand how to distinguish between those two scenarios, the silver market will teach you that lesson in the most expensive way possible. So let's talk about the machinery operating beneath the surface and why technical chart patterns, Yes, even the ones that have historically worked reliably can start giving you false signals when a market becomes dominated by a concentrated group of large institutional players. For years, one of the most peculiar characteristics of the silver market has been extreme concentration, not broad participation, not diverse liquidity, concentration. A relatively small group of large financial institutions has maintained, for an extended period, a short position that is disproportionately large compared to virtually every other commodity market in existence. I'm not saying that to be sensational or dramatic. I'm stating it because concentration fundamentally changes everything about how a market behaves. In a typical commodity market, price discovery is messy, but widely distributed across thousands of independent participants with different motivations, different time horizons, different capital structures. In a concentrated market, price can still move, of course, but it moves through much narrower channels of control, and that means the chart pattern can appear clean and textbook, while the actual positioning underneath it is anything but normal. So when someone confidently declares, the technical pattern clearly indicates silver should move to X level, you have to immediately ask yourself, is that pattern functioning in a genuinely free market with distributed participants, or is it functioning in a managed market with concentrated control? Because those are not the same game. They don't follow the same rules. They don't produce the same outcomes. Now, this raises an obvious question that usually gets dismissed with vague explanations. Why would any rational institution bother concentrating short positions in silver in the first place? The standard answers are always hedging, portfolio management, normal market-making activities, just routine finance operations. But silver is not just another industrial metal, and it's definitely not just a decorative commodity for collectors and jewelry enthusiasts. Silver occupies a unique intersection of monetary value, industrial necessity, and strategic importance. On the industrial demand side, silver is absolutely everywhere in modern technology. Electronics, photovoltaics, solar panels, medical applications, high-precision manufacturing, advanced defense systems. It appears as a small component in countless critical systems, which makes it invisible and taken for granted until the moment you actually try to substitute it with something else and suddenly realize you cannot. And then there's the dimension that makes people uncomfortable to discuss openly in polite financial conversation. Defense and strategic demand. High-performance military and aerospace systems don't select materials based on marketing or trends or cost convenience. They select materials based on measurable physical properties: conductivity, thermal stability, reliability under extreme stress conditions, performance consistency in hostile environments. When the operational environment becomes extreme, when failure is not an option, you reach for the material that works reliably, not the one that happens to be cheap this quarter. That's precisely why silver shows up in applications and systems that the average retail investor never sees and rarely hears about. Now, I'm not here to transform this into some kind of conspiracy entertainment channel. I'm here to explain market incentives clearly because incentives shape behavior and behavior shapes markets. If silver is genuinely strategically important to critical national security systems and industrial infrastructure, you can immediately understand why there would be an institutional preference for stable, contained, predictable pricing rather than chaotic price spikes that disrupt supply chains and budgets. And when you combine that structural incentive with a paper derivatives market that can expand and contract supply on a screen far faster than physical supply can actually move in warehouses and refineries in the real world, you create a market structure that can persist and function smoothly until suddenly, catastrophically, it cannot. And that brings us directly to the element of this story that matters most urgently right now: delivery stress. Because paper derivative games function perfectly fine as long as nobody actually demands physical delivery of the underlying asset. The moment too many market participants say, "No thank you, I don't want cash settlement, I want the actual metal delivered to my vault," the entire structure and dynamic changes fundamentally. And recently, we've been observing clear signs that an increasing number of participants are actively choosing physical delivery. Even during contract months, where historically delivery demand has been relatively quiet and manageable, that behavioral shift matters enormously. It matters because it's not a social media rumor, it's not a sensational headline, it's observable behavior backed by capital. When you see significant numbers of contracts standing for delivery rather than rolling forward or settling in cash, you're watching real institutional capital making a clear statement. I don't trust paper settlement promises. I trust metal in hand, in my vault, under my control. And when that behavior expands and accelerates, it becomes a genuine stress test of the entire market infrastructure. Now, one of the cleanest and most reliable stress indicators in commodity markets is something most retail investors never learn about until they have already been badly burned by ignoring it: market structure. Specifically, the relationship between spot price and futures prices across the curve. In a comfortable, well-supplied market operating normally, futures prices trade above spot prices. That's the natural state. You're paying for time, for storage costs, for insurance, for financing, and for the simple economic reality that money itself has a time value. When that relationship inverts, when spot price starts trading above futures prices, a condition called backwardation, you're witnessing a market that is willing to pay a premium to have the metal immediately, right now, rather than waiting for future delivery. That is not normal behavior. That is urgency. That is fundamental distrust. That is the market collectively saying, promises of future delivery are not good enough anymore. I need physical possession now. And when backwardation shows up persistently in precious metals markets, it tends to appear well before the mainstream financial narrative catches up and reports it. Now, let's connect all of this directly to the psychological importance of the $100 price level. People treat $100 like it's magical simply because it's a round number. But the actual reason it matters so profoundly is both psychological and structural simultaneously. Psychological, because traders, algorithms, and retail investors anchor their decision-making around it. Stop-loss orders cluster around it. Financial media writes headlines around it. Retail momentum chasers pile in around it, expecting a breakout. It becomes a stage, a focal point for attention and emotion. Structural, because if there are large institutional short positions that were comfortable and profitable at $70 per ounce, increasingly nervous at $85, and genuinely sweating at $95, that incremental push toward $100 can transform mild discomfort into full emergency mode. And emergency trading behavior looks completely different from normal strategic trading. Emergency trades don't wait patiently for optimal prices or favorable conditions. They just need the price to move away from the danger zone immediately, at any cost. That's precisely why you can observe sudden dumps of massive contract volumes during odd overnight hours when liquidity is thin. That's why you witness price hits that appear completely irrational and unexplainable, unless you remember one crucial thing. Somebody executing those trades might not be trading for profit optimization. They might be trading for survival, for risk management, for avoiding a margin call or a catastrophic loss. Now, here's a specific detail that should make you stop and think carefully. While Western paper pricing gets aggressively smashed downward, the premium for physical metal in key Eastern markets has remained persistently elevated. We're talking about a sustained premium of several dollars per ounce, where physical metal is being valued materially higher than the paper price in Western markets would suggest is appropriate. That price differential creates a simple but brutally effective arbitrage mechanism. If you can acquire price exposure cheaply in one geographic market and convert it into physical metal that commands a premium in another market, you've created an arbitrage vacuum that sucks metal systematically from west to east. Every price dip in Western paper markets becomes a strategic opportunity for physical metal to flow eastward. And once metal physically moves into strong hands in Eastern vaults, it doesn't casually wander back to Western markets on a whim. So when you see a sharp price smash on your screen and your immediate instinct is to think, oh no, silver is weak, the trend is breaking, I should panic and sell, pause that reaction and ask yourself a different question. Did the physical premium in Shanghai or Singapore or Mumbai collapse simultaneously? Because if the physical premium stays elevated and firm while the paper price gets hammered down, that dip may be less about genuine fundamental weakness and much more about transfer of ownership. Transfer from leveraged hands to unleveraged hands. Transfer from paper claims to physical possession. Transfer from Western financial players to Eastern physical accumulators. And that pattern is not bearish for the long-term trajectory. That is a structural drain on available supply. Now, I want to be extremely careful and precise here because this is important. None of this analysis means that silver cannot experience a significant price drop in the near term. It absolutely can. Silver can drop violently even within a broader bull market, the same way a lion can stumble while running at full speed. It doesn't stop being a lion just because it stumbled. In fact, silver bull markets throughout history are famous, almost legendary, for producing terrifying pullbacks that shake out weak hands and test conviction ruthlessly. So I'm going to say something that sounds contradictory on the surface, but represents the core truth. Short-term tactical caution and long-term strategic bullishness can and should coexist in your thinking simultaneously. If you're actively trading short time frames with leverage, you must respect volatility, manage risk tightly, use stops intelligently. If you're stacking physical metal for long-term wealth preservation, you respect fundamental supply and demand dynamics, and you manage your emotional reactions to price volatility. If you unconsciously mix those two completely different operational modes without clearly understanding which mode you're in at any given moment, you will get absolutely destroyed. And that's exactly why the next part of this discussion matters so critically: margin requirements. Because margin is the silent, invisible killer in silver markets during volatile periods. Here's precisely how the trap operates mechanically. When silver starts moving aggressively higher, the leverage available in futures markets looks incredibly tempting and attractive. A relatively small amount of capital can control a large amount of metal exposure. Everyone feels intelligent. Everyone feels like they got in early. Everyone feels like an absolute genius riding the wave. Then, usually at the worst possible moment, the exchange announces they're raising margin requirements to manage risk. Suddenly, the exact same position size requires significantly more cash posted as collateral. And if you don't have that additional cash immediately available, you don't get the luxury of holding through a temporary dip. You get forced to liquidate and sell directly into the dip at the worst possible price. That forced selling pushes the price down further, which triggers additional margin stress for other leveraged longs, which forces more selling, which pushes price down more. It becomes a self-reinforcing liquidation cascade. And that cascade is precisely what large, cash-rich institutional players with patient capital absolutely love, because they can step in calmly and accumulate positions at distressed prices. When you're not selling by choice based on your analysis, when you're selling by force because of margin requirements, you're handing your position to someone who wants it at a discount. This is exactly what experienced traders mean when they talk about shaking the tree or flushing weak hands. It's not poetic metaphor. It's cold mechanical reality. And the particularly cruel aspect of this dynamic is that the shakeout and forced liquidation doesn't require the underlying fundamentals to change at all. No new supply needs to magically appear. No demand needs to suddenly vanish. All that needs to happen is that enough leveraged participants get squeezed simultaneously by margin increases. So when you hear news that an exchange raised margin requirements after a big upward move, understand exactly what that really means in practical terms. It means the rules of the game changed overnight in a way that specifically targets and pressures leveraged long positions. Now imagine you're that leveraged trader for a moment. You're holding multiple futures contracts. You were perfectly fine, comfortably within margin requirements yesterday, and today you wake up to a notification that says, post significantly more cash immediately or reduce your exposure. That's not a market opinion you can debate. That's an ultimatum. And it's precisely why silver price drops can feel like falling off a cliff rather than a gradual decline. But here's the critical twist that most people miss. Those cliff-like drops often end abruptly the precise moment that the forced sellers have been completely cleared out of the market. And what happens immediately next is the part that nobody expects or anticipates in real time while it's happening. Once the weak leveraged hands have been flushed out completely, the price often snaps back violently higher, not because of some magical chart pattern or technical indicator, but because serious buyers with deep capital were waiting patiently, strategically, for the forced liquidation to do exactly what it was designed to do. That's why you frequently observe a sharp, aggressive move downward followed almost immediately by an equally aggressive recovery move higher. It's not random chaos. It's systematic redistribution of positions from weak hands to strong hands. Now let me paint a very specific scenario for you, because this is where the narrative becomes particularly interesting and relevant. Imagine you're a large institutional short seller, and you've operated successfully for years inside a comfortable trading range. Every single time silver attempts to rally, you lean against it aggressively. You sell paper contracts, you trigger stop-loss orders, you wait for momentum traders to lose interest and get bored, and then you buy back your short position at lower prices for a profit. Rinse and repeat. That strategy feels as reliable as gravity. It feels like a machine that prints money consistently until the day the floor suddenly disappears beneath you. What makes that floor disappear isn't a chart pattern or a moving average crossover. It's a fundamental change in who is buying and why they're buying. When the buyer on the other side is a leveraged speculator chasing momentum, you can scare them easily, push the price down sharply, raise margin requirements, create scary headlines, and they disappear. They sell, they quit. But when the buyer is a manufacturing company that needs the metal for production continuity, or a sovereign entity building strategic reserves for national security, fear tactics don't work on them. They don't care about your candlestick pattern or your scary price action. They care about securing physical supply at reasonable prices before it becomes unavailable. That's precisely why the East-West physical premium differential matters so enormously. If a physical trading hub in Asia keeps paying elevated premiums consistently, even when Western paper markets get smashed downward, that's the market voting with actual capital. It's saying clearly, we'll take all you can send, ship it here now. And if you want a simple mental model to understand this dynamic, picture a sponge sitting in a sink. Every single time the paper market dumps silver aggressively to scare leveraged speculators, the sponge quietly absorbs it. The sponge represents physical demand that doesn't flinch or panic. It doesn't check technical indicators. It just absorbs. Now here's the dangerous cliffhanger hiding inside that sponge metaphor. If the sponge keeps absorbing consistently, the paper market can continue painting whatever price it wants on screens for a while longer, but only as long as the paper market can actually source physical metal when someone demands delivery. That's the high wire act. That's the tightrope. This is where the phrase failure to deliver transforms from dramatic language into something much more serious. It becomes the moment when the market stops being primarily a price story and starts being a plumbing and infrastructure story. Because if delivery requests keep rising steadily while available, registered inventories don't increase proportionally, you eventually get a squeeze that isn't driven by hype or social media excitement. It's driven by contractual obligations and legal requirements. That's also why we keep hearing repeated reports that certain major banks have dramatically changed their positioning or flipped their stance entirely. In plain, practical English, it means some large institutional players are no longer comfortable being net short silver, and they would much rather be positioned long than be the last institution holding the bag when the music stops. And when big players with inside information change sides, it's rarely because they suddenly discovered a new philosophical appreciation for silver's monetary properties. It's because the risk profile changed materially. It's because the exit door started to look dangerously narrow.